I think there is a serious chance we are in the early phase of a currency crisis, not just here or there, not just in one weak country at the edge of the system, a real systemic problem. And the reason I say that is not because I suddenly became dramatic. It is because people are starting to wake up to something that governments and central banks have tried very hard to keep hidden inside official language and doctored statistics. Inflation is not an accident. It is policy. It is not something that falls out of the sky like bad weather. It is created deliberately, repeatedly. And the people in charge do not really fight inflation. What they fight is your awareness of it. They fight your perception of it. They fight the moment when ordinary people stop blaming bad luck, greedy companies, wars, and weather, and start seeing the common thread underneath all of it. More currency, more credit, more dilution. That is the thing I want to talk about. Because once the public begins to understand that inflation is the plan and not the mistake, behavior starts changing, and when public behavior changes fast enough, what begins as ordinary inflation can turn into something much more dangerous. Ludwig von Mises had a phrase for this, the crack up, boom. He described the moment when people suddenly understand that inflation is not temporary, not accidental, and not under control. At that point, they stop wanting to hold money, they want anything else. Goods, property, metal, tools, food, stocks, land, anything but the currency itself. They are no longer buying because they need the thing, they are buying because they no longer trust the money. That is the point where the psychology of the system changes, and I think we are moving closer to that point. Now, before anyone says this is extreme, let us stay practical official. Inflation numbers are already soft political theater. Governments revise baskets. They change methodologies. They emphasize the numbers that flatter them and explain away the numbers that do not. But CPI was never the cleanest definition of inflation anyway. The truer place to look is the money supply. That is where the source starts, and it is exactly where I would start too. Look at M3 in the UK. It is making new highs again. That is inflation in the real sense. More money, more claims, more currency units, chasing the same world of goods, labor, property, and services. Yes, they expanded the money supply aggressively in 2020 and the years around it. Yes, they briefly tried to step back, but the larger pattern is plain. They cannot really stop because the whole debt structure sits on top of continued expansion. That is the trap. Now layer oil on top of that, not because oil is the true source of inflation, but because it is one of the first places people can visibly feel it. The source argues that the screen price for oil is fake in the same sense that many futures prices detach from what real buyers are paying in stressed conditions. It points to physical barrels trading far above quoted prices and gives examples of extreme transaction levels in disrupted markets. I think the precise anecdote matters less than the larger point. Energy costs are staying elevated, and when energy stays elevated, everything downstream feels it. Transport, food, heating, manufacturing, packaging, everywhere you turn, energy is sitting underneath what you consume. But even here, I want to be precise. Oil is not the root cause. The root cause is still policy. Government spending that crowds out the private sector. Central bank balance sheets that stop shrinking and start expanding again the moment stress appears. Restrictions and distortions that reduce real supply while authorities keep expanding nominal claims. That is why I do not talk about inflation as if it were some natural disaster. It is engineered through decisions. The source points to the Bank of England balance sheet and says what matters is not that it has gone vertically wild again in one clean move, but that it stopped shrinking and started leaning upward. I think that is right. These things do not need to explode instantly for the direction to matter. Once liquidity support stops being reversed and begins expanding again, the signal is clear. The system cannot tolerate hard discipline for very long. That is always the tell. They may talk hawkishly, they may pretend restraint, but once the real pressure builds, liquidity comes back. Now I want to show you the point where I think this starts becoming visible to ordinary people, in a way no statistician can talk them out of. The source uses a ratio I like very much. The average UK house price measured in gold, not in pounds in gold. That is a completely different way of looking at things, and a much more honest one. Because if you measure a house in a currency that is being constantly diluted, you can mistake nominal growth for real wealth. But if you measure a house against money that cannot be expanded at will, the picture becomes cleaner. The source says this ratio is now broken below its previous extreme low from 1982. That means the amount of gold required to buy an average UK house has fallen beneath a level that had stood for decades. Think about what that implies. Either gold has become dramatically more valuable, or houses are being repriced in a weakening currency so quickly that the pound itself is giving way relative to hard assets? The answer, of course, is both working together. Gold has been signaling stress. House prices keep rising in pounds. That combination is exactly what you would expect to see if the public is slowly moving toward an anything but currency mindset. And that is what the source is really worried about. Not just inflation, the behavioral turn, because once people stop treating currency as a store of value and start treating it as a hot potato, the process feeds on itself. You notice prices rising, you start buying early. Your neighbor notices you buying early. They start stocking up too. Retailers raise prices faster. Wage pressure follows late and poorly. Savings accounts look more ridiculous by the month. Bond yields no longer feel compensating. And then everyone who thought they were being prudent by staying liquid discovers that liquidity was just another word for being trapped in the wrong asset. That brings me to what I think is the most important practical point in the whole piece. The most dangerous place to keep your savings in this environment is in the currency itself. Cash savings accounts, government bonds, that is where people are most vulnerable, and the reason is simple. If the currency is being diluted faster than your nominal yield compensates you, then you are not preserving capital. You are watching capital evaporate slowly in polite accounting language. A savings account paying 3% or 4% sounds respectable until you realize the purchasing power of the currency may be dropping far faster than that. The same is true of government bonds. The source focuses on gilts, but the mechanism is broader. If you lock yourself into a fixed income security paying a fixed return while the market begins demanding more yield to compensate for inflation and currency risk, then the value of your principal falls. That is the fundamental law of bond investing. When yields rise, prices fall. You may still receive your coupon. The government may still pay you, but the real value of what you own is deteriorating. That is why a long bull market in government bonds was so bullish for everything else. Falling yields lifted asset prices, reduced financing costs, and made the whole credit machine feel effortless. Now the direction is reversing, and when that direction reverses, people who thought they were being conservative by hiding in government paper may discover they are simply volunteering to be diluted in slow motion. The source argues that this is how it looked in the 1970s. I think that is broadly right. People did not necessarily lose nominal money in cash or government paper. They lost purchasing power. And for many households, that is what matters, not whether the government mails the payment, whether the payment still buys anything worth having. Now, if that is the danger, where do you want to be? The source gives the answer plainly. You want to be in real things, not promises, not paper claims alone. Real things, stocks of companies that produce actual goods, gold and silver scarce assets. Anything likely to reprice faster than the currency is being diluted, and it goes even further than that. It says gold and silver will likely outperform stocks in a true crack-up. Boom, I think that is a serious possibility in the kind of environment being described here, because stocks can still be weighed down by taxes, policy interference, margin compression, and all the ordinary foolishness of corporate life. But the monetary metals respond much more directly to the public's loss of faith in the currency. They are not growth assets in that moment. They are exit assets. That is a very different role. The source also points out something people often misunderstand when they see stock indexes at all. Time highs during troubled times. They think the market must be celebrating peace or better growth or some clean macro story. Sometimes the market is simply repricing the currency. Sometimes indexes are rising not because companies got dramatically more productive overnight, but because the unit used to measure them is being weakened. That is why you cannot simply look at nominal highs and conclude all is well. In a crack-up environment, nominal highs can coexist with deep monetary trouble. That is the whole point. Now let me bring this down from the macro level to the level of ordinary life, because this is where the source becomes especially effective. It uses everyday examples. A jar of coffee that used to cost one thing now comes in smaller packaging at a much higher effective price. Restaurants charging separately for the things that used to come with the meal. Airlines monetizing every seat choice. 3 simple items at the store suddenly feeling absurd. That is not just inflation. That is inflation plus shrinkflation plus behavioral adaptation by businesses that know the consumer is being squeezed. And when enough ordinary people start noticing that the old money does not stretch the way it used to, their behavior changes. That is why I pay attention to anecdotes like that, because official data can be massaged. The lived experience of daily purchasing cannot be hidden forever. If your grocery bill, your coffee, your utilities, your travel, your rent, your small luxuries, your emergency purchases, all keep marching higher while the government tells you inflation is cooling. Eventually, you stop listening. That is when credibility starts breaking. And monetary systems run on credibility for longer than most people realize. The source believes we are near that psychological inflection point. I think it may be right, not because everyone wakes up at once, because enough people are starting to suspect that holding the currency is the losing side of the trade. That is the crack-up dynamic. So what should the practical conclusion be? Not hysteria, not bunker fantasies, not doing something foolish just because cash is losing appeal. The correct conclusion is much more sober. Do not anchor your financial safety to cash and government paper alone. Do not confuse a fixed nominal yield with real protection. Do not treat house prices, stock prices, and gold prices as separate stories when they may all be reacting to the same underlying problem: the loss of purchasing power in the currency. And do not let the authorities keep you in the boiling pot by convincing you that modest interest on savings is safety. It is not. Safety in a currency crisis looks very different. It looks like ownership of things the system cannot print: productive businesses, hard assets, monetary metals, real claims on real output. That is where I would want to stand. Because if the source is right, and if the public is beginning to move from mere inflation awareness toward an anything but currency mentality, then the people clinging to paper promises will be the ones who discover too late that they were standing on the weakest part of the balance sheet all along. That is why I think this matters now, not in 5 years, not after the headlines start calling it obvious. Now, before the crowd fully catches up to what the currency is telling them,